What if I told you investing 1 lakh rupees in Apple 10 years ago would have made you over 10 lakhs today without doing anything? Sounds amazing, right? But here's the twist. Many Indians who did this actually lost money. Shocking? Let me explain. With the Indian stock market hitting all-time highs, many smart investors are now eyeing global opportunities, and the US market tops that list. From tech giants like Apple and Nvidia to ETFs like the S&P 500, the US stock market has created countless millionaires. And platforms like Groww, Vested, and INDmoney have made it easier than ever to invest in dollars directly from your phone. Imagine this. You invest $1,000 in a US stock. The stock grows by 10%, but the Indian rupee strengthens against the dollar by 10%. You just made 0% return in INR terms. In 2020, INR was around 74 per dollar. Now it's about 83 per dollar. That's great for past investors. But if this reverses, your returns could shrink despite stock growth. Indian investors often forget that foreign investments are taxed differently. You don't get LTCG benefits like Indian equity. Instead, you're taxed at 20% with indexation after 2 years and no exemption up to 1 lakh rupees. A 5 lakh rupees gain in US stocks means a 1 lakh tax bill. No 1 lakh free LTCG like in Indian stocks. The S&P 500 is at all-time highs. Nvidia's up 200% in a year. Sounds exciting? Or dangerous? Investing now means you could be buying at the top. In 2022, Nasdaq dropped nearly 30% in just a few months, wiping out gains of the previous 2 years. You can start an Indian mutual fund, SIP with 500 rupees, but US stock investing is still dollar denominated. Even fractional shares cost 800 to 1000 rupees minimum. Not everyone can invest consistently. Now that you know the risks, here's why US investing can still make sense if you do it the right way. Don't put all your eggs in one market. If India underperforms or faces political turmoil, your US portfolio can act as a cushion. You simply can't access Apple, Tesla, Nvidia, or Google by staying only in Indian stocks. These companies shape the future. If the rupee weakens, your US investments become more valuable. It's like a natural currency insurance for NRIs or frequent travelers. Conservative investors might want to put, say, 15% of their equity portfolio in US stocks. If you're balanced, 25 to 30% could work. And if you're aggressive, you could go up to 50%. For most people, using ETFs like SPY, QQQ, or VTI is a smart move. Or you could look at mutual funds like Motilal Oswal Nasdaq 100 or Franklin US Opportunities Fund. Use Indian platforms like Groww, INDmoney, or Zerodha. Many now support SEPs into US mutual funds, which is super convenient. So, should Indians invest in US stocks in 2025? The answer is yes, but not blindly. Understand the risks, start small, diversify smartly, and think long term. Remember, global investing is a marathon, not a sprint. Are you investing in US stocks yet or waiting for a better time? Let me know in the comments. If you found this video useful, like it, subscribe, and hit the bell icon for more global investing insights.